I always say I don't care where stocks come from. I don't care where it's going. Does it really matter if you bought Disney at 180, it's now in the 90s? I mean, other than the pain it caused. Does it matter if you bought PepsiCo at 177, now 157? It shouldn't. But there's one exception to this rule. When you buy a stock with an extremely low price-to-earnings multiple, and yet the darn thing still goes lower. That's because these stocks only look cheap thanks to the fact that the earnings estimates for the out years, for next year, for next quarter, are too high. They can go lower and then lower and then lower some, and these numbers come down and down. Sometimes they go all the way to zero. I first saw this happen in the late 1980s when I was trading Bethlehem Steel, which used to be an iconic American company. This thing was supposed to earn $13 a share, so it struck me as a fabulous buying opportunity because the stock was only at $26. What could be cheaper than a stock trading at 2 times earnings? I figured I'd make a killing if anything good happened. And nothing good happened. First, the dollar got very strong, making domestic steel producers less competitive. Foreign steel came in from everywhere, dumped by countries with cheap labor. Then the company reported catastrophic earnings. Mess. Bessie, as we called it after its symbol, BS, didn't make $13 per share. It actually lost money that year. The stock wasn't trading cheap at 2 times earnings because the multiple was a chimera. Next thing you know, the stock did get cut in half, and we had a recession that never really recovered.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.